Hello and welcome to this special interview here on Money Paathshaala. Joining me today is a veteran of Indian equity markets, Prateek Agrawal, who is currently the executive director at Motilal Oswal Mutual Fund, but has 3 decades of experience in managing equities and has been at various places and very closely looked at India's equity markets. Thank you very much, Prateek, for coming by. And
Thank
since
you.
we are speaking for the first time in your new avatar, congratulations and wish you all the best in your journey.
Thank
My
you so much.
first question, Prateek, is we've seen almost close to all-time highs. And then, of course, as it happens in equity, there is always corrections that happen. While, of course, this is not a live interview, so we don't know by the time this goes where the Sensex would be at. But the point is, let's talk about valuations. How do you see valuations at this point of time and the road ahead for India's capital markets?
Yeah. So, my construct for the level of the market is 18 and 18 and a half times 1 year forward earnings. We are in fiscal 24, so at the end of 24, so March 24, one would be looking at what happens in March 25. Now, as per current understanding, current projections, we should end 24 at between 950 and 1000 EPS for Nifty, and 25 can then be 1100 to slightly bigger EPS numbers, kind of a range. If you multiply that with 18 and a half, I think the number that you are getting is around 19 and a half to 20,000, kind of a ballpark number for Nifty. And that leaves us with a 10-12% kind of upside from here over the period of a year, which then means it is less than a percent a month in terms of compounding on larger cap indices, and should prepare us for a period of consolidation. Now, is there anything in the marketplace that would cause me to improve on this 18 and a half P band? I think no, because this is mostly dictated by the discount rate, by the hence interest rate prevalent in the economy. So yields are declining, rates are yet to decline. I think this is a number which should be achievable. Let's not go overboard this number just now.
Oh.
Now, the other thing that one has to keep in mind is the substitution effect. If, let's say, one country goes out of favor, there would be, let's say, emerging market flows to some other country. In the past period, we saw that, Russia came in favor earlier part of the year before Ukraine happened, and then lost favor and the monies came back. Something similar happened to China and all of that. So those shift in investor preferences can cause changes for some time. And similarly, substitution effect in a large index like an MSCI may also do so. But none of these things seem imminent. So I would believe from where we are, given what we discussed on the larger cap side, we should expect a period of consolidation.
What are the broader themes or constructs that you are looking at? You've been with Motilal Oswal now for 9 months. It's a very equity-centric kind of a mutual fund house and an institution. What is it that in the market in terms of themes that you are looking at, and what is your strategy? What have you done? What do you intend to do going forward?
Sure. So, as people are aware, we are a quality and growth focused house. So QGLP is the philosophy that we follow. And there, while Q is defined as in terms of quality of business measured by ROIC kind of a parameter, and we want to make sure that ROICs are high enough to fund the growth that the company may be expected to do over next several years. Uh, Quantum of growth and longevity of growth, both are super important, and this is where themes come in. So, since we are growth investors, we look for growth oriented themes. Themes make sure that growth in a business lasts for more than 2 years, which becomes the projection period actually for most of us guys now. And it is actually, if the growth sustains beyond those 2 years, is how growth will translate into returns for the investors. So, to give you how we think, and this is something which we did with all of the then 9 managers sitting in the room with me piloting the process, and with, of course, the IC, RA, and Naveen sitting there as well, is flesh out very narrow themes, and we can dwell on it. But narrow themes like, instead of healthcare, let's talk hospitals, which we believe offers the highest longevity of meaningful growth in the healthcare space. Maybe small, pharmacies can do so, but those are not investable in large manner. Hospitals, we have a larger choice. Over over branded Indian generics, over specialty and branded generics, over generic, over bulk drugs. So that becomes the pecking order. Similarly, we said, so now all of our funds, so whatever we are talking would now be seen across our funds. So all of our funds would have something in healthcare, mostly in a hospital name. Similarly, we said new tech is good business, good valuations, but ownership changes will cause volatility. Today, if you see across the house, we would be invested into names like a Zomato, Paytm, or a Nykaa. Different schemes, different choices that the manager may make, but these would be represented mostly, with some small exceptions. We said large cap IT is something which may continue to see growth issues going forward. I mean, easier way of understanding is they have their fingers in everywhere. It's a slowing world, so something or the other will get impacted. So look at smaller companies which have the tailwind of the spaces that they may be focused on. They may have the advantage of now being able to qualify for larger deals, or they may be positioned in a geography which is just about starting to look at offshoring to India and have them. So it's not that we don't have the larger IT names in the house, but in a very small amount, more as a risk control measure. Mostly we have the second rung IT names, and they have seen good times in the past period happily. The third big differentiator is financials, for example, where we have moved away from corporate lenders. By and large, if you see the newer buyings that we have done, it is retail focused lenders. Now, what happens this year is that the corporate lenders, so every bank would have a mix of corporate and retail, but larger corporate lenders would have a part of, let's say, working capital funding as well. Now, in a lower inflation year, for example, you don't have that tailwind. So, if you look at the market commentary, you will find larger banks, which are mostly having a large part exposure to corporates as well, talking of growing in the 12 to 15% kind of range, while the retail focused NBFC converted to bank kind of banks would be talking of business as usual 17+% kind of growth. So, we being growth investors, we want this variety as long as we are sure that they are doing a good job of it and not lending fast beyond what the system can take and cause NPAs.
Hmm.
And yes, China plus one played through three spaces. For example, chemicals, which we believe is a very long-term high growth story, highest volume growth story you will find here. So we have across the house names in that space, or a garmenting company, or EMS as a space which is clearly coming up. So this is what we have been doing. Good quality quotient, very high growth quotient, and in the space that we have spoken about, we believe valuations, corrected for growth are benign, way more benign than the highest quality space. So this is what it is. Some of the tailwinds that we may experience is that some of our businesses, as time goes by, can see very material improvement in ROICs, return on invested capital.
Hmm.
Now, over the past few years, for example, we have seen advent of REITs and InvITs in the country. Now, earlier, if somebody was in a hotel business and we are there in a luxury, so on the consumption side, we are only in luxury hotels, wedding clothing, premium shoes, jewelry kind of businesses, or fast fashion as a house mostly. Now, thing is, if we are speaking asset businesses like a hospital, like a hotel, like a mall, uh, increasingly because of REITs, InvITs kind of structure, the asset can be offloaded into a REIT. Okay, and suddenly what is left in a listed company is the management and asset light nature, and suddenly you see ROCs expand hell of a lot. So in the hotel business, we know that most of the hotels are now going in leveraging their brand, going in for management contracts. Now there are hospitals talking of doing the same. Running the hospitals on fees rather than building the infra. And in malls, already the one large listed player does it. Builds it, gets it populated with tenants, and then sells it off, at least 50% of it, to global guys, and makes itself asset light. So, this is something which, as people understand more and more, will make for higher valuation in these spaces. These are spaces which could grow for a very long time in excess of the economic growth rate, and could also see a combination of improved ROCs.
Hmm.
Higher ROCs mean higher cash flows, and that has a DCF valuation implication.
Prateek, there is a lot of excitement right now in the small cap, mid cap space as well. And as it happens, whenever there is a particular theme that runs in the market, retail investors tend to jump in and feel that, okay, this is a momentum, I can go with it, without realizing probably the risks associated. What is your view on the mid cap and small cap universe? Are there good stories there that you are betting on? Do you see it continuing, the strong growth in that space?
This space is large. Okay, and the disclaimer is that one needs to be very careful addressing this space. However, if I talk about this space, something that comes to the mind is from November onwards, in my write-ups, in my videos, I've been saying this is time for alpha. Now, it is time for alpha because alpha versus the larger cap index, or even something like a BSE 500 kind of an index. It is because newer spaces are popping up and they are sustaining growth while they are still not there in the index, for example. in any meaningful manner. So spaces like, we discussed China plus one. There is no name in the index, which is a huge beneficiary of China plus one. All of the names lie, when I say index, in an index like Nifty, all of those names lie outside of it. So chemical companies, garmenting companies, EMS companies are all outside of it. And well, the growth story may have been a tad older for chemicals, starting for garmenting. In EMS, we may have had two companies, now more are coming in. So for many of these, it's a beginning of a very long journey, hopefully. And hence the chance for alpha by deviating from the index. Similarly, in many other spaces, when you say engineering, there may be one or two engineering companies in the index, and that too more focused on coal-based capex, that corporates may be doing. Most of the other names have tended to be smaller. They are outside of the index, and now with so much focus on Make in India, the whole space is seeing tailwinds. Hospitals simply not there in the index. One name, very small in the index. Very long runway of growth, and so on. So now all of these spaces, most of the names, if not all of the names, are in the mid cap space. So my whole sense is mid caps is where the themes are best represented, but the idea should be to be with leadership businesses in the space rather than with businesses which have failed to become large cap in spite of being around for 1 or 2 decades. There maybe it is a problem of opportunities, fire in the belly kind of stuff. Lastly, I think the period from 12 to 20 was a very different period where reforms that we were getting were difficult. We had to endure COVID kind of a difficulty, which was more favorable to large cap in terms of market access, in terms of being able to withstand it. And in this period, you saw mids getting decimated. Import duty protection was low. What businesses could do in the country was, it was a shrinking space. Post COVID, from the bottom of COVID, frankly, we are seeing a trend of, moving away from China, for example, which is benefiting every country and India in extending protection to domestic markets, sourcing more from domestic. And it is manifested in margins as well. Margins have improved, spread of earnings have improved. So 12 to 20 mid-cap earnings simply did not increase. Very flat. Even 21, the first year of COVID, actually declined. But after that, they are ticking up. They have been very buoyant, and even for last quarter, as buoyant as the large cap index. So those tailwinds are definitely there. Now, one caution is while large cap index is just about where it was at the last peaks, last two peaks have been similar. So this is the third one. Mid cap index is now higher, substantially higher than the past peak. In that sense, it is now looking a tad more expensive. Like I made the case for the larger cap index, one should be ready for a period of consolidation. But there is a lot happening in this space. If one is with the leaders of this space, I think in this space, buy on corrections should continue to be a great strategy.
One final question, Prateek. You've been handling equities in various positions for more than 30 years. And if we look at the last 25 years, people who stayed invested in equities made very decent returns. I mean, there are multiple mutual fund schemes. I'm not even talking about direct equity, but multiple mutual fund schemes that have delivered over 20%, 21% CAGR over 25 years and compounded serious wealth, but very few Indians actually participated in that growth of the markets. I mean, or stayed invested for that long a period of time. Uh, if there is a 25-year-old who's listening to you today, what would you tell her for the next 25 years? Is there enough growth opportunity in India to make good money through equities? I'm not asking you how much we will make because nobody can predict that. But typically, one would say, oh, but we've already grown by this much. So can we grow? Can our markets grow? But from whatever I've heard you say so far, there is enough and more wealth to be made even in the next 25 years.
One, I don't think I need to tell the youngsters what they should do. They're already doing it. A lot of the money that comes into the market in a very, very regular manner through SIPs and through inputs into mutual funds month on month is the money of youngsters. I think formalization of the economy has attributed to it, plus the fact that we have seen such strong growth over such long periods of time. And I speak of experience from my own son. I had this conversation where after he put in his first few monies into a mutual fund, markets fell. And he says, पापा मार्केट तो गिर गए हैं, तो अच्छा है ना, हमको सस्ता मिल रहा है. मैंने कहा बहुत निर्वाड़ा हो गया तेरा तो. So this is the kind of and fresh out of college guy uh, getting his first job, investing some small surpluses, and I think this is what is seen across the country. If we map when people are investing more, it is when markets fall. When we see when net monies are lower. So last month markets made a new high, net inflows were lower. The month before markets were probably lower. We saw very high inflows kind of stuff. So I think we are seeing a huge maturing of Indian investors, helped by formalization, helped by regulation, which is making mutual funds kind of structures cheaper for investors and much better regulated. Uh, in terms of growth story forward, uh, you know, I don't know about 25 years because the only example we have is of China, which did well for that period, and we may have used 5-10 years of that. So let's not talk 25 years. It is possible. We are still a very poor country, just about or over $2,000, $2,200 per capita. Similarly looking countries like a Thailand, Malaysia, forget China, are 2x, 3x richer on per capita. And if we reach even their levels, we should be as an economy over a 10 trillion economy, which will probably take over a decade to reach. So from 3.5, today the first goalpost is 6, then maybe 10, I think. So for 10 years, even if as an economy, even if as a race, we need to just be where Thailand, Malaysians are already there. And why I say is because when you go there, they feel very, very like India, very similar to
Hmm.
India.
Hmm.
uh, that runway of growth is definitely there. And if you then want to reach up to where China is, it could be longer. This is a country where you see brilliance all around, and that should make people confident. Go to the West, see people struggle if you make changes at the cash counter. Try doing that and try doing it in India. In India, it is taken in the stride. Nobody will say anything in the West. Well, you will hear choicest of words. So that is the difference. The fire in the belly that you have in India, big cities, yes, but if you go to smaller cities, it's not funny. Is not funny. Brilliant people wanting to achieve more for themselves, their families, their country is something which is not paralleled. So, that we will grow and deep into the future is a given.
Right.
How deep, fast is something that time will tell. I will take it differently. how many people thought we will win medals in athletics,
Oh,
in Olympics? It's happening, right? Uh, Sports after sports where we thought others would do better, people have started to give competition and are highly ranked.
oh,
Yesterday, I had this, you know, experience of a 19-year-old Hyderabadi kid coming to our office, and I met him in the canteen, and he runs a business which makes 350 crores of revenues and close to 300, if heard it right, PBT, and he has started that business. So, we looked up to the West for technology leadership, and we mimicking them. I think it is changing. While we are still followers in many spaces, we are leading now in many as well. So that gives a lot of confidence. That gives a lot of. In fact, if you look at the latest generation, in the past when you and me were younger, we prayed that we should not change, and any amount of capex that we have done in the past we are able to sweat for longer, and we were always reluctant adopters of change. Now
oh,
look at it this time. Somebody is saying EV autos are our largest this thing. We are saying हम तो पहले करेंगे.
oh.
Same thing with solar, same thing with UPI, industry after industry, spaces after spaces. This is a country which does not want to, keep holding to what was the past. It increasingly wants to be seen to be leaders of change, a huge change. And which makes me very confident that going forward, as the thought leadership comes, the economic leadership, economic growth leadership should also come and sustain for long.
Always a pleasure talking to you, Prateek. Thank you so much for coming by, sharing your wisdom, which you have, with a lot of hard work, built over many, many years. I do look forward to many more conversations with you. Thank you very, very much for taking time out. Thank you, Prateek.
Have a great day. Bye bye.